Risk associated with investments. All investments carry some degree of risk. All investments such as stocks, bonds, mutual funds, and exchange-traded funds can lose some or even all their value if market conditions change. It is important to understand the type of risk that may impact your investment returns before determining and implementing your investment strategy. Although a single risk premium must compensate the investors for all the uncertainty associated with the investments, there are numerous factors that may affect and contribute to investments uncertainties.
First, let's define what is business risk. Business risk refers to the uncertainty about the rate of return caused by the nature of the business. It is the ability to generate sufficient revenue to cover its operational expenses and achieve its financial goals. Anything that threatens a company's ability to achieve its financial goals is considered business risk. Yung business risk ay nagdedepende sa nature ng isang business. Pwedeng hindi nila ma-achieve yung target objectives or sales nila at hindi sigurado yung return dahil sa mga factors like financial instabilities, financial losses, movements in the stock prices, foreign currencies, and fluctuations in the interest rates that causes financial leverage. Financial leverage means it is the use of borrowed money to finance all the needs in the operation of the business. Risk or uncertainty of the business might come from inflation or economic fluctuations. If that happens, a company's operating expenses and sales will be greatly affected. As an example, when you purchase a stock, you are purchasing a piece of ownership in a company. With a bond, you are loaning money to a company. Returns from both of these investments depend on sales and financial stability of a business. If a company goes bankrupt due to uncertainties and its assets are liquidated, the company's bondholders will be paid first, then holders of preferred stock. Pero kung ikaw ay common stockholder lang, makukuha mo lang kung ano yung natira, which is pwede ding wala. Business risk greatly affected the investor's decision, especially in deciding if they will invest or not. As an investor, you want to know how fast your money will grow, how safe your money will be if you invest in a business, seeking for higher returns and avoid financial losses. Default risk also related to the chance that some or all initial investments will not be returned. It is the type of risk that measures the chances of not fulfilling the debts and obligations such as non-repayment of principal amount or interest. Ito yung risk na kung saan yung isang entity or borrower ay hindi nababayaran yung mga present debts and obligation nila sa lenders or investors. Example nito is nagiging default yung isang company kapag hindi nila nabibigay yung mga interest sa mga ini-issue nilang bonds or hindi nila na ibabalik yung mga principal amounts ng mga investments na pumapasok sa kanila. Financial risk is the possibility of losing money on an investment or business venture. The firm's capital structure or sources of financial determine financial risk. Financial risk refers to the ability of the business to manage debt and fulfill financial obligations. Financial risk is the risk that a company won't be able to meet its obligation to pay back its debts, which in turn could mean the potential investor will lose the money invested in the company. The more debt a company has, the higher the potential financial risk. Financial risk is kung hindi inutang yung capital, maganda kasi direct sa net income. Pag galing naman sa debt, doon nagka-problema kasi nahahating revenue sa pambayad ng liabilities plus the interest rate and expenses. Financial risk is a type of danger that can result in the loss of capital to interested parties. Interest rate risk. It is the potential for the investment losses that result from a change in interest rates. If interest rate rises, the value of a bond or other fixed income investment will decline and vice versa. Because money has a time value, fluctuations in interest rates will cause the value of an investment to fluctuate also. Interest rate risk refers to the fluctuations na may incur ng investment in your portfolio. Some investments yield in interest rates. For example, a year matured interest-bearing investment grew a 1% of its principal amount in the same year after the amount fluctuated because of risk. One of its risks included there is inflation. Kahit yung investment ay nag-grow ng 1% from its principal amount, maybe yung inflation will fluctuate more than sa value ng interest na acquired. Although the prices of all bonds are affected by interest rate fluctuations, the magnitude of the change varies among bonds. Different bonds show different price sensitivities to interest rate fluctuations. Thus, it is imperative to evaluate a bond's duration while assessing the interest rate risk. Liquidity risk. Liquidity risk is associated with the uncertainty created by the inability to sell the investment quickly for cash to prevent or minimize loss. It is basically describe how quickly something can be converted into cash. In the simplest terms, liquidity risk refers to the risk that an investment won't have an active buyer or seller when you are ready to make a transaction. In extreme cases, liquidity risk can cause you to take huge losses because you have to mark down your property at the fire sale prices to attract buyers. Liquidity risk directly relates to how easy it is to buy or sell assets. The more liquid an asset, the easier is it to convert it to cash and find ready buyers. Assets that are illiquid take more time to convert to cash and sell. Example of high liquid assets include stocks, mutual funds, exchange traded funds, cash and cash equivalents such as money market fund or money market account. Assets that tend to be more illiquid included real estate and land, hedge funds, options contract, stock futures, private equity investment. Management risk. Management risk is the risk financial, ethical, or otherwise associated with ineffective, destructive, or underperforming management. Management risk can be a factor for investors holding stock in a company. Management risk basically talks about the management itself. How does executive address the different problems and concerns? And how does executives run the business? Management risk refers to the chance that an investor's holding will be negatively affected by the management activities of its directors. Purchasing power risk, also known as inflation risk, is the risk that inflation will undermine the real value of cash flows made from an investment. Thus, inflation erodes the purchasing power of the peso and increases investor risk. Inflation risk is the chance that the cash flows from an investment won't be worth as much in the future because of the changes in the purchasing power due to inflation. Inflation risk is a way to describe the risk that inflation can pose to a portfolio over time. Specifically, it refers to the possibility that the rising prices associated with inflation could outpace the returns delivered by your investment. Risk associated with manufacturing, trading, and service concerns. In a manufacturing process, consideration needs to be given to the potential risk associated with ongoing day-to-day activities. Risk can arise due to the nature of the materials in use, the equipment, the people, and etc. It's important to have a program in a place which can identify the various risks that may arise. Market risk is the risk that a business faces due to the decrease in the market value of a financial product arising out from the factors that affect the whole market. Market risk is the chance that an individual or other entity will experience losses due to the factors that affect the overall performance of the business in the financial market, such as the product risk and competitor risk. Product risk is the risk that you may not actually be able to deliver your product to the market within the resources that you have because of the complexity, obsolescence, research and development, packaging, delivery of warranties. Aside from that, competitor risk is the chance that competitive forces will prevent you from achieving your goals due to the actions of competitors, such as the pricing strategy, market share, and market strategy. Operations risk, it summarizes the uncertainties and hazards a company faces when it attempts to do its day-to-day business activities within a given field of industry. Sinasabi niyang operations risk is the prospect of loss resulted from inadequate or failed procedures by the business. Sinasabi na dahil sa mga errors na ito or failed procedures done by the business is one of the factors that contribute to ineffective operations. Example nito yung mga process stoppage, health and safety, after-sales service failure, environmental problems, technological obsolescence, integrity such as management fraud, employee fraud, and illegal acts. Financial risk. Financial, as the term suggests, is the risk that involves financial loss to the firm. Financial risk is one of the high priority risks for every type of business. It is caused due to the market movements, financial instability, and losses in the financial market. Also, it, it caused by the interest rates volatility, foreign currency, liquidity, derivative, and viability. Business risk refers specifically to anything that could threaten a company's financial health or lead to insolvency. Business risk can come from a wide variety of sources, both internal and external, so it is important to understand where and how your company may be most vulnerable to such dangers. Example of business risk: regulatory change, reputation, political, regulatory and legal, shareholders relation, credit rating, capital availability, business interruption. In addition, natural disasters, rising prices of raw materials, labor cost, rising interest rates, and competition, stock price
Fluctuations.